Welcome to our in-depth tutorial on the risk-return spectrum. In today's video, we will explore one of the most fundamental concepts in investing and finance. We'll discuss what the risk-return spectrum is, why it matters, and how it can guide your investment decisions. The risk-return spectrum is a crucial concept for investors. It illustrates the relationship between the risk of an asset and the expected return from that asset. Generally, higher returns come with higher risk and lower returns with lower risk. Let's start with the basics. An investor always seeks to maximize return while minimizing risk. However, achieving this balance isn't straightforward. The graphical representation of various investment options along the spectrum can help visualize this balance. Now let's illustrate this with a simple example. Imagine you have $10,000 to invest. You could choose a risk-free asset, like a government bond, which offers around a 2% return. Alternatively, you could invest in a high-risk tech startup, which has the potential to offer a 20% return but also comes with a higher chance of loss. Here is a simple formula to calculate return. If you invest $10,000 in a government bond with a 2% return, the calculation would be 10,000 times 0.02 is equal to $200. You see, lower-risk investments like government bonds yield lower returns, while higher-risk investments like startups have the potential for higher returns. This is the essence of the risk-return spectrum. Now, let's discuss the different types of investments along the risk-return spectrum. On the lower end of the spectrum, we have risk-free assets like treasury bills and savings accounts. These are considered the safest investments but come with the lowest returns, around 1 to 2%. Next, we move to medium-risk investments like corporate bonds and blue-chip stocks. These assets tend to offer higher returns, usually in the range of 4 to 8%, but with increased risk. At the high-risk end of the spectrum, we find investments like emerging market stocks and speculative investments. These can offer returns greater than 10%, but they come with significant risk. Consider a real-life scenario. Between 1999 and 2009, the S&P 500 had an average annual return of minus 0.95%. This period, called the lost decade, underscores the risks even in traditionally safer investments like diversified stock indices. So how do you determine which investment is right for you? This depends on several factors such as your risk tolerance, investment horizon, and financial goals. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Generally, younger investors may take more risks, whereas older investors might prefer safer assets. Now, let's make it more interactive. Here's a question for you. If you are saving for retirement that is 30 years away, would you opt for higher risk investments? If you said yes, you are willing to take on more risk for the potential of higher returns, which is typically recommended for longer-term goals. The idea is that time can smooth out the ups and downs of the market. Data supports this strategy. Historically, the stock market has provided an average annual return of about 7 to 8% over the long term. However, this requires a greater tolerance for risk and a longer investment horizon. Let's summarize what we've learned today. The risk-return spectrum helps investors understand that higher potential returns come with higher risks. By knowing your risk tolerance and investment horizon, you can make more informed investment decisions. Thank you for joining us on this exploration of the risk-return spectrum. If you found this video helpful, please like, share, and subscribe for more finance tutorials.